Good morning, everybody. Today we are continuing with our monthly webinars, and we're also continuing with our discussion of IFRS 16 on leases. Last month we looked at the identification of leases and we looked at determining the lease term, and both areas quite difficult areas in the new IFRS 16. Today we're moving on and we're saying, if I'm a lessee and I'm applying IFRS 16, what are the requirements around recognition and measurement? Now, you should have received an email with the slides earlier this morning. Otherwise, you can also download from the software the PowerPoint slides if you haven't received them. So, outline of this webinar. Today we only have 3 sections. First of all, we'll look at the initial recognition and measurement, and remember we're focusing on lessees. And then secondly, we'll look at subsequent measurement, and then we'll end off with remeasurement of leases. When would we remeasure? How would we remeasure? Another area that I think we should consider, and we will schedule a webinar for that in the coming months, is what about lease modifications? And then the big one, transitioning to IFRS 16, which can be a very complex area with a number of transitional provisions. But in today's webinar, we're just looking at 3 areas: initial recognition and measurement, subsequent measurement, and then the remeasurement of leases. So let's get started. As always, remember this is just training, it's not technical advice. And if you need technical advice, please contact your BDO IFRS contact person or other BDO contact person. So if we look at initial recognition and measurement, initial recognition and measurement, a bit of an overview about the process. So we start off by saying, is our transaction, is our lease in the scope of AASB 16? And we said going forward, there will be a lot of discussion and debate whether we actually have a lease, whether it meets the definition of the lease, and whether it's in the scope of IFRS 16 or AASB 16. If we've determined that we are in the scope of AASB 16, we will move on and say, okay, are there any of the recognition exemptions that we can apply? And if we've not applied any of those recognition exemptions, sorry, it's jumped, we would get to recognition. So if we make the assumption for today's webinar, we're a lessee, we are within the scope of AASB 16. The recognition exemptions are not being applied, and therefore we would like to recognize this right of use asset and this lease liability, and it's about initial recognition and initial measurement in this section. So let's start with the lease liability. Now, the lease liability is initially recognized and measured as follows. The measurement of this lease liability consists of the present value of the following payments that have not been paid at the commencement date. So I suppose it's important that we just have a look at commencement date of a lease. So commencement date of a lease is the date on which the lessor makes an underlying asset available for use by a lessee. And at that commencement date, we have to come up with the net present value of all the payments that have not been paid at the commencement date. And there's a number of aspects, and there's 5 parts to it. The first part is fixed payments. Oh, there's jumps again. What's going on? The first part is fixed payments less your lease incentives receivable. Your second part is certain variable lease payments will be included. Please note, not all variable lease payments will be included, only a few. Then we also include residual values that's been guaranteed. We also include the exercise price of purchase options and potentially the exercise price of termination options. And that adds up to our lease liability. So we start off by calculating the lease liability, which is the net present value of these 5 aspects. If we look at some of them in a little bit more detail, and we start off with, and you can see on the right-hand side on the top, in that green circle, I've got fixed payments less lease incentives receivable. So we've got fixed payments include the set payments outlined in a lease contract. So this is the easy one. It's fixed. These are the payments we're going to make. This is when we have to make these payments. Calculate the net present value of those future payments. The harder part is that some payments may be structured in a way that they appear to have variability. But if you really look at their nature or the circumstance surrounding them, they are actually unavoidable, and therefore they are in substance. I'm going to move this now, so I don't know why this is jumping. Some payments could be in substance fixed lease payments. So a fixed lease payment is not just a set payment at a particular date. We have to consider the variable payments and determine whether these variable payments are potentially in substance fixed lease payments. So examples of these in substance fixed lease payments could be payments that are being based on a presumed underlying assumption. So the assumption is that the leased asset will have to operate during the period. That's, if the payment is based on the fact that the asset have to operate, that's an in-substance fixed lease payment. A payment that is structured as containing genuine variable components, where the variable component will be resolved during the term of the lease. So let's say payments that become fixed once the lessee's base level of use of the asset has been established in the first year. Now these payments become in substance fixed payments when we've resolved the variability. I don't know what's going on, I'm getting so frustrated, the slides are continuing to move on. I do apologize for that, I have no idea why that is happening. So it looked like a variable payment, but they become fixed, let's say, when we reach a certain sales level. As soon as the variability has been resolved, it's an in-substance fixed payment. It could also be the third bullet point, that there's more than a single set of potential payments. There's more than a single set of potential payments that a lessee may have to make, but only one option is realistic. Because only one option is realistic, we've got an in-substance fixed lease payment. We could also have a situation where there is more than a single set of potential payments, but at least one must be made. So this is where we've got a minimum. There's a minimum payment that we have to make. It could be more, but there's a certain minimum payment, and therefore that minimum amount is an in-substance fixed lease payment. So if we look at an example, what about a low minimum payments? Let's say we've got a lessee enters into a 15-year lease of retail space in a shopping center. Now the minimum rent is $100 per year unless sales exceed $1,000 per year. Now, if the sales revenue exceed $1,000 per year, the lease payments are actually $50,000. So if you look at that, it looks as if there's variability. So it could either be $100 per year or it could be $50,000 per year. However, the lessee has historically generated sales revenue at its retail locations of between $150,000 and $250,000 per year. And the store must operate within certain specified regular operating hours. So there appears to be potential variability. However, in this situation, we would argue that we've got in substance fixed lease payments. The lease contract technically specifies variable payments in that rental payments can either be $100 or $50,000. However, it's not realistically possible that the lessee will have less than $1,000 of sales and therefore only pay a minimum rent of $100. The only really realistic alternatives is that sales will be more than $1,000 and therefore the lease payment is $50,000. So we would say there's no true variability here, and therefore there's only one realistic outcome, and your lease payment would be the $50,000 per year. And it's the $50,000 that you will use to come up with a net present value. So that is an example. Another example, what if our lease payments are entirely based around sales? Now, I think commercially, I'm struggling to see how we would do this and how it would commercially make sense, because I think a lessor would be very hesitant to structure a lease payment that's completely and entirely based around sales. I would have expected commercially a lessor would build in some minimum, and then there could be some adjustment if sales reach certain levels. But let's look at this example. Let's say a lessee enters into a 15-year lease of retail space in a shopping centre. There are no fixed lease payments stipulated in the contract. They only say that lease payments are 5% of annual sales. Now, the lessee demonstrated to the lessor in negotiating this contract that it generates at least $125,000 per annum at each location, and on average $150,000. So in this situation, again, the question would be, do we have variability? Now, here we would argue there are no fixed lease payments, agree. Now, although there is a high degree of certainty that the lessee will incur a lease expense of at least the $6,250,000. How did I calculate that? I said 5% of the sales of $125,000, and because we know in the past they've generated sales between $125,000 and $150,000. So if you look at it, we're thinking a minimum seems to suggest 5% of $125,000. Variable lease payments that are linked to future performance of an asset or the use of an underlying asset are specifically excluded from the definition of lease payments. So in this situation, although we've got a lease, we won't have any fixed payments that we can discount to come up with a lease liability on day one. The standard specifically says that variable lease payments that are linked to the use of that underlying asset would be excluded from the calculation of lease liability, and it's not a fixed lease payment. So that's an interesting thing to note. If you could structure a deal where your lease payment are entirely based around the use of that underlying asset, you would not have to apply or you wouldn't have a fixed lease payment, and you wouldn't book a right of use asset and a lease liability on day one. As I've said earlier, commercially, I just cannot see why a lessor would enter into this arrangement. Another example around potential in-substance lease payments. Now, in this example, we've got a lessor leases medical equipment to hospitals and also sells consumables that are used in the operation of the equipment. So I'm thinking maybe it's an X-ray machine, and maybe the consumables is something that we need for these x-rays, or maybe it could be maybe it's not medical equipment, but maybe a photocopier and there's consumables involved, like ink or paper. So something like that. So we sell the medical equipment and we also sell consumables. Now the lessor grants the lessee, the hospital, the right to use the equipment at no cost for a period of 10 years. So they're saying, hang on, you can use this equipment for 10 years, you don't have to pay for it. However, in return, the customer agrees to the following: that the lessee is not obliged to a minimum purchase of consumables, but the lessor must be the exclusive supplier of the consumables to the hospital. If the lessee chooses to purchase that item, we'll definitely purchase it from the lessor. The price per consumable ordered is $10, and based on past experience, the lessee estimates consumption of 25,000 consumables per year. And at a minimum, the lessee believes that 5,000 consumables will be used per year. Now, in this situation, again, the question is, do we have a fixed lease payment that have to be discounted to come up with a lease liability or not? Now, in this situation, the contract does not contain a minimum order for consumables that the lessee must place. So there's no obligation to order a minimum amount. Consequently, similar to our previous example, because these variable payments are linked to the future use of the medical equipment, and remember the payments for the equipment are included in the price of the consumables, they are excluded from the definition of lease payments, and no lease liability and no right of use asset is recognized initially. So if the contract actually contained a minimum order quantity, that would give rise to a fixed lease payment, and we would have calculated a lease liability and then also a right of use asset on day one. So I think it's really important when we look at initial recognition that if we go back, just want to take you back a few slides, a lease liability is calculated as the present value of all these payments. And if you look at that first block, fixed payments, we have to make sure that it's a fixed payment. And even if it looks like a variable payment, that it's not an in-substance fixed lease payment. However, if there's variability that's linked to the use of the underlying asset, we should not include that. So quite a few lessons to learn around that. If we continue with the lease liability, and now if you look on the top right-hand corner, we now look at variable lease payments and how do we account for variable lease payments. I think we should remember that variable lease payments can take multiple forms. Variable lease payments may be indexed to a rate such as inflation, LIBOR, or maybe CPI, or your variable payments could be linked to the performance of the asset itself. So that's a percentage of sales for a retail store in a shopping center. So variability could be linked to many things and could take variable forms. And we'll have to look at the real underlying reason for the variability in order to determine the accounting treatment. So if we've got variable payments that depend on an index or a rate, so CPI CPI or LIBOR, we would say we would include it in the initial measurement of the lease using the index or the rate as at the commencement date. And we'll remeasure the lease in the period that that rate or that index changes. So we know we've got variable payments up front. The only thing we can do is use that index or that rate at the commencement date. And yes, if the rate or the index changes in future periods, we'll remeasure. We could also have in-substance fixed payments, which we've just discussed in some detail. And in substance fixed payments, again, will be included in the initial measurement of the lease. Again, we will remeasure the lease in the period that the in substance fixed payments are changed or are resolved. So that, if there are changes and we have to remeasure, we do it in the period that that happens. We don't do it initially. Remember, all of what we're talking here is initial recognition and measurement. There could also be other variable payments. We do not include other variable payments in the initial measurement of the lease. We would recognize in profit or loss when that event or condition that triggers the payment occur. So the first two, variable payments that depend on an index or a rate, and in substance fixed payments, both of them will be included in the initial measurement of this lease. And we will remeasure going forward if the rate or the index changes. And we will look at an example on how we remeasure a bit later. For other variable payments, however, it will not be included as part of this initial measurement, but going forward, if there's a condition or event that triggers this variable payment, we would recognize it as profit and loss. That's the normal rule. But in certain situations, you could include it in the carrying value of another asset. So that could be if this underlying asset is used to manufacture inventory, so it could be included in inventory, or to construct a building or some other asset, PPE. Let's look at an example to think a little bit more about this. What about a variable lease payment or variable lease payments that depend on an index or a rate? So in this example, we're in year one, we're at the beginning of the lease, and the lessee enters into a 10-year lease of property with annual lease payments of $50,000 payable at the beginning of each year. The contract specifies that lease payments will increase every 2 years in line with the increase in the Consumer Price Index, CPI, for the preceding 24 months. Now, the Consumer Price Index at the commencement date is 125, and the lessee has determined that an appropriate rate or discount rate for the lease payments is 5%. Now, at the commencement date, the lessee makes the lease payment for the first year and then measures the lease liability for the future lease payment. So it's 9 payments of $50,000 that's going to happen over the next 9 years. And we have to discount it at the interest rate of 5% per annum, and that gives us a number of $355,000, 391. So at the beginning of the lease, the lessee will initially recognize the assets and liabilities in relation to this lease as follows. Will debit a right of use asset for the full amount, credit the lease liability for the 9 payments of $50,000 that will be made over the next 9 years, and credit cash. That's the lease payment for the first year. So here you can see, although we always say, listen, the right of use asset and the lease liability on day one is usually exactly the same, if you are paying payments in advance, the right of use asset and the lease liability will not be exactly the same on day one, because a portion of the right of use asset we've actually paid for in cash on the commencement date. What we really wanted to flag in this example, however, is that in measuring the lease liability, the lessee does not make any estimate of how future changes in CPI will impact future lease payments. Rather, it assumes that these initial lease payment, the $50,000, will remain constant during the lease term. And later on, we'll discuss, so what if we now know what the CPI index is 2 years later? How do we adjust for that? So on day one, we look at the fixed payments being the $50,000 that will be paid. Another example, which is a slight extension of this, let's say we've got the same example. We enter into a 10-year lease, $50,000 payable in advance. It will increase every 2 years in line with CPI. Currently it's 1 to 5, but the new thing is the bullet point in red. The lessee is also required to make variable lease payments for each year of the lease. And how do we determine the variable lease payment? They're determined as 1% of the lessee's sales generated from this leased property. So we know we've got a fixed portion, the $50,000 per year. Now we also have a variable portion. We have to consider whether that variable portion is an in-substance fixed payment or not. You will remember we've said if it's linked to performance of the underlying asset, we exclude it. And therefore, the solution to this example is exactly what we had for the previous example, because we ignore this variable lease payment. If we continue with the lease liability, and now we focus on residual value that's been guaranteed. Now, in some leases, they require the lessee to guarantee the value of an asset when it's returned to the lessor. So the lessor is saying, I'm leasing you this asset for a period of 3 years, but I want some protection that when I get this asset back in 3 years' time, you've looked after it well, you've done the necessary repairs and maintenance, and due care of the asset. We want you to guarantee that the value of the asset that you return to us. Now, it could be that the guaranteed value or the amount that the lessee guarantees is more than the expected fair value of this asset at the end of the lease. So I have to guarantee the value of $100,000 in 3 years' time. However, the expected fair value of the asset is only $80,000. Therefore, on day one already, I know that the lessee or that I, as lessee, will have to make a payment of $20,000 to the lessor. And therefore, that $20,000 has to be included in our calculation of the lease liability on day one. Now, commercially, I'm struggling to see why, as a lessee, I would guarantee a value of an asset if I think that guaranteed value is more than the expected fair value of an asset. But if that is to happen, we have to build that into our lease liability. If we continue with the lease liability, and here we focus on two parts at the same time, and that's the exercise price if we've got purchase options or exercise price of potential termination options. Now, amounts that a lessee expects to pay to either purchase this underlying asset or to an amount that we'll pay to terminate a lease by exercising a termination option should be included in the calculation of the lease liability. So this is all about amounts that a lessee expects to pay. So based on our expectation, we know we've got an option to terminate this lease. If we don't expect to terminate the lease, it will not be included. However, if I expect to terminate the lease and then therefore I expect to make this payment, it will have to be included in the calculation of your lease liability. Now, you remember last month we talked about the determination of the lease term. Now, your expectation on what you're going to pay on these options to terminate a lease will have to line up with how you've determined the lease term. If I've said I'm never going to use my termination options and therefore I think my lease term is 10 years, then in this calculation we will not start to discount termination payments because we didn't factor it into our lease term calculation either. So there has to be some consistency between what we do for lease term and what we do when we calculate and initially recognize and measure our lease liability. So if we put all of that together, I would say slightly differently, we would say our lease liability consists of fixed payments, it consists of some variable payments, it consists of that residual value that we've guaranteed as a lessee, and then also we also include purchase and termination options that we expect to pay. And I've said there in that red block, right at the last end, we only include these purchase and termination options if the lease term also reflects the fact that we're going to exercise these options. So this is a little bit of a summary of what we've discussed in this webinar to this point. I was thinking it might be interesting to get your view in a poll question. So question is, I wanted to ask you whether your lease payments currently are linked to CPI, LIBOR, or inflation. So if you think about your current contracts that you've got in place, to what extent would we see that link to CPI, LIBOR, or inflation? At the moment, we've got 42% of you voted. Let's see if we can get 60% of you to vote. It will be quite interesting just to get an idea. I asked this question because, as you know, and you can see it in the slides, that certain variable payments have to be included in the calculation of the lease liability on day one. So if you've got a variable payment that's actually linked to a rate or an index, for example, CPI, it would be included in that calculation. So important to know whether you currently have that or not. So at this stage, we've got 55% of our attendees have voted, so that's a big group, so let's have a look at that. So at this stage, we've said 63% of you indicated that you do have lease payments linked to a rate or an index, and therefore you'll have to include it in the net present value of your lease liability on day one. All right. So if I just want to remove the bold. Yeah, correct. So everybody should be seeing the slides again. Beautiful. The other big part that impacts this calculation of the initial recognition and measurement amount is the discount rate on initial recognition. Now, this is always a big discussion point, and you will know often when we do impairment tests, you know, we talk about what is the appropriate discount rate. Now, leases going forward, there will be a lot of discussion between clients and auditors around what is the appropriate discount rate to use. So the first option or alternative is that the standard setter would like us to use the interest rate implicit in the lease, unless it's not readily determinable. So if you look at all these lease payments, we have to say what is the interest rate implicit in the lease, and let's use that interest rate to come up with a lease liability on day one. They give us an out. If it's not readily determinable, let's look at our incremental borrowing rate. Very often it's difficult to determine the implicit interest rate in practice, and therefore we use this incremental borrowing rate. So you'll have to consider things like, you know, what would be the interest rate that I would pay if I have as security, you know, a similar right of use asset. what would be the interest rate if my borrowing is of a similar term to the lease term, and also what would be an interest rate if my borrowing is in the same currency as our current lease payments. They specifically say that it's inappropriate to use weighted average cost of capital. And the reason for that is because weighted average cost of capital incorporates the cost of equity-based capital, which is unsecured and ranks behind other creditors. So they don't want us to use that. Really what we're trying to come up with this incremental borrowing rate is we apply the concept that we're looking for a similar security. A lessee uses the right of use asset granted by the lease as our security, and therefore we look at the right of use asset as security and not the fair value of the actual underlying asset, because potentially you only have the right to use the asset for 5 years, so you should look at the security is the right to use an asset for 5 years. That has a very different value than the fair value of the underlying asset that potentially has an economic useful life of 20 years. So the value of the underlying asset would not necessarily equal the value of the right of use asset. In certain situations, it could, if you've got the right to use the asset for the majority of its economic useful life, but I think in a number of instances, especially property leases, it would not be the same. So if we look at an example, now this is an interesting one, and that's why I thought I'll flag it with you, and that is where we've done our calculations and we come up with a negative implicit interest rate. So let's say the details, entity M leases a unit in a shopping centre for 5 years, and lease payments are fixed at $150,000 per year, plus a 5% variable payment dependent on entity M's annual sales revenue. So there's a fixed part and there's that variable part that's linked to usage of the underlying asset. We know because it's linked to the usage of the underlying asset, we exclude it in our calculation of our net present value of our lease liability on day one. Now let's say the lessee's incremental borrowing rate is 8%, and the retail location has a current fair value of 1.3 million and an unguaranteed residual value of $350,000. Now in this situation, IFRS 16 first requires the rate implicit in this lease to be used if it's readily determinable. So you cannot immediately go to the incremental borrowing rate. You first have to see, can I come up with this implicit rate of interest? As entity M knows the fair value of the property at the commencement date of the lease, and has estimated the fair value of the asset at the end of the lease, the rate implicit in this lease agreement can be calculated. Because IFRS 16 specifically defines the interest rate implicit in the lease as the rate of interest that causes the present value of, number one, the lease payments and the unguaranteed residual value to equal the sum of the fair value of the underlying asset and any initial direct costs of the lessor. So if you do that calculation, however, with this fact pattern, you'll see that we come up with an implicit interest rate of negative or minus 8.52. Now, if we would use this negative interest rate, we'll actually have interest income instead of interest expense. So that just doesn't make sense. And therefore, the use of a negative discount rate in this circumstance is not appropriate because it does not reflect the objective, which is to reflect how the contract is priced. So in this situation, will go and use the incremental borrowing rate of 8%. So, to be honest, in practice, I think it will be very rare that a lessee will have information about the lessor's direct costs and other expectations that you would need to calculate that implicit interest rate. And to be honest, I haven't seen implicit interest rates included in these lease contracts. So in that situation, although we have to try, I think usually we would come short and we'll end up with the incremental borrowing rate of the lessee. However, before we go on to the right of use asset, I thought I'll just test my understanding of disclosure of that implicit interest rate and ask you a question again. Now, my question is, do your lease arrangements include an implicit interest rate? So if you're a lessee, can you see an implicit interest rate in that contract? Is the lessor including the implicit interest rate? It would be really interesting to just test, what I expect with reality. IFRS experts, we live on a cloud, and it's always good for us to just check in with reality. So let's see how many people we can get to vote on this one. So do you see that implicit interest rate in your lease arrangements? At this stage, about 50% of you voted. If a few more could vote, it will give us a more, let's say, realistic, trustworthy answer, actually. So that would be very nice. All right, so at this stage, let's close it. We've got around 55%. So if we close it, interesting. 11% of you say that you can find your implicit interest rate in the lease contract, and you will therefore have to use that implicit interest rate to come up with your calculation, unless it's a negative implicit interest rate, because that wouldn't make sense. So that would be something to look out for. I can't think a lessor is going to put in a negative interest rate. 60% of you said no, and 29% unsure. So that is fairly aligned with what I had in mind. For those of you unsure, I think it would be important to have a look, because if you have that implicit interest rate, you'll have to use it for these calculations. Many of you might argue that that's actually a good thing, because then you don't have to have the fight internally and with your auditor on what the incremental borrowing rate is. Right, so let's move on. So in the first part of the webinar, we have just focused on how do we initially recognize and measure that lease liability. I would now like to move on to the initial recognition and measurement of that right of use asset. Now, you know that we always say that on day one, you debit right of use asset, credit lease liability, usually they'll be the same. We've already seen one instance where they would be different, and that is where you're making payments in advance, or at the beginning of a year or a month. When you look at the calculation of the right of use asset, yes, the starting point is the lease liability, but then we also add to that lease payments made at or prior to the commencement date. So your lease liability is what you still owe going forward. We add to that what we've already paid at the commencement date, or even if you paid it before the commencement date. We also add to that in the initial direct costs that you as lessee have incurred to get everything ready. We also include potential costs to remove or restore this lease asset at the end of the lease. And that lines up with the requirement in AASB 137 that if you've got a restoration cost at the end of use of an asset, that you create that provision for restoration or dismantling at the net present value on day one. And if it relates to a leased asset, it will be included in the right of use asset, similarly to how it would be included in property, plant and equipment if it related to property, plant and equipment. And then we also deduct from this amount lease incentives that we've received. So we no longer have a separate interpretation for lease incentives. Lease incentives that we've received will be deducted from our right of use asset. So that's the formula. If we talk a little bit more about what are initial direct costs, so these are incremental costs of obtaining a lease that would not have been incurred if this lease had not been obtained. So, these initial direct costs could be finder's fees, it could be commissions to agents for establishing the lease, it could be legal fees. I think what's really important is that IFRS 16 emphasizes that direct costs must be incremental in the context of each individual lease and not on the basis of a portfolio of leases. So this really precludes an entity from making an allocation of admin costs that relate to obtaining a lease. So for instance, maybe you have a person that, or a team that renegotiate leases on an ongoing basis. You cannot apportion a part of that team, the finance or the management team's salary, to this right of use asset because it's not an incremental cost, it's not over and above what they normally do, it's not an incremental cost to obtain a lease. It has to be linked to incremental cost to obtain a specific lease, not maintaining a whole set of leases. So these costs would not be incremental because they would have been incurred regardless of whether the entity entered into this specific lease or not. So please be careful for initial direct costs and how you look at incremental costs. The other one I want to look at is removal and restoration costs. So some leases contain a requirement for a lessee or for lessees to return an asset in a specified condition, such that the lessee would be required to incur a cost to restore it. I think a good example is if you lease 2 floors in a building and you would like to put in place an internal staircase so people don't have to use the lifts the whole time. In that situation, it's quite an expensive exercise, and often lessors require that you remove the internal staircase before you move out of that building. So that's a good example where on day one you'll have to include in your right of use asset that potential repair or restoration cost. So the journal would be a debit of right of use asset, the net present value on day one, and you credit the provision for restoration. It's not a lease liability necessarily, but it's a cost that you have to incur, a restoration cost, so AASB 137 would be applied. So also certain types of assets may have significant transportation and removal costs to return them to the lessor, and you have to incur that cost. And these types of obligations may be incurred at commencement date of a lease, or it could be incurred as a consequence of using an asset. So it doesn't really matter. It has to be included in your right of use asset. Let's look at an example of a right of use asset. In this example, entity Z, the lessee, enters into a 5-year lease of a floor of the building with an option to extend the lease for a further 5 years. Now, lease payments are $50,000 per year during the initial term and $55,000 per year during the optional period, and they're all payable at the beginning of the year. Now, to obtain the lease, entity Z incurs initial direct costs of $20,000. So it's $15,000 to the former tenant that's occupying the floor and $5,000 for real estate commissions. Now the lessor agrees to reimburse that real estate commission to you. So you pay it and then they'll give it back to you. At commencement date, Entity Z concludes that it's not reasonably certain to exercise this option to extend the lease. And therefore the lease term, it's not reasonably certain to exercise the option to extend, and therefore the lease term is 10%. Listen, I think in my facts I have added in an extra knot. I would say, let me just double check that. From my calculation, my right of use asset, it must be, surely it must be, yes, sorry, we enter into a lease. It's not reasonably certain to exercise the option to extend the lease. I do apologize. It has to be, it is reasonably certain that we're going to extend the lease. We have a lease for 5 years and we've got an option to extend for a further 5 years. If you could please fix that bullet point. At the commencement date, Entity Z concludes that it is reasonably certain to exercise the option to extend the lease. Therefore, on day one, we believe the lease term is 10 years. So that knot should be removed, please. The rate implicit in the lease is not readily determinable, and Entity Z's incremental borrowing rate is 5% per annum. Now, this rate reflects the fixed rate at which it could borrow an amount similar to the value of this right of use asset, so the right to use this building for 10 years, in exactly the same currency and for a term of 10 years with similar collateral. So if we make an assumption that we're going to lease, or we think it's probable that we're going to lease it for 10 years, when we look for an incremental borrowing rate, we have to have in mind a 10-year period as well. So how do we do this calculation? So we would say we debit the right of use asset with the $423,000, which is the answer of that calculation. We credit the lease liability with the 373, and we credit cash the 50,000 that we paid on commencement date. We then incur initial direct costs, so we credit cash for the $20,000 and we debit right of use asset. And then we've got an incentive. The lessor refunds the estate agent commission or the agent commission. So when we receive that, we say debit cash and we credit that right of use asset. So that's how our lease incentive is taken into account under IFRS 16. All right, so that was all about initial recognition and measurement, which is the biggest issue in IFRS 16. When we look at subsequent measurement, the lease liability as subsequent accounting is similar to any other interest-bearing liability. There's a little bit more guidance on remeasurements, which we'll look at soon. But the essence of it is that for the lease liability, you have to calculate an amortization table using this incremental borrowing rate, if that's the rate that you've used to come up with the net present value of your lease liability. So you've got your opening balance, you add your interest on it, you deduct your lease payments, and you'll deduct the principal amount of your lease payments, and then you also have to factor into potential remeasurements. We'll look at that soon. If you look at subsequent measurement of the right of use asset, we've got 3 potential measurement models. You could either measure this right of use asset, this building, using the cost model as outlined in AASB 116, a property, plant and equipment. You could also have a lease of a building and decide that you want to use the revaluation model to account for that right of use asset, and then you'll use the principles in AASB 116, which means changes in fair value will go to reserves, other comprehensive income. But there's also a third alternative. You could also use the fair value model for investment property, which would mean you account for your investment property at fair value in the balance sheet, and changes in the fair value will be reflected in profit and loss. So 3 different models. So the third one, clearly you'll use if it's investment property, or you've got it available to use if it's investment property. But you can decide which measurement model you want to use. Now again, I've got a view on what I think people will do, but let me check with you. So which measurement model do you think you would be using for your right of use asset? Would you use the cost model? Would you use the revaluation model? Or do you have a right of use asset that's actually an investment property, and therefore you would like to use the fair value model with changes going through profit or loss? So it would be very interesting to see what you think about this one. I think currently most people would use the cost model. My expectation would be that most people would account for a right of use asset using the cost model. But let's sense check it. I'm very interested in your feedback and your thoughts on this. So at the moment, we've got 43% of our attendees have voted. You know, you can't be right or wrong here. It's just your view, your opinion. Please participate and share with all of us what you think. It will be really interesting. Quite interesting. A number of attendees of these webinars have given me feedback and said they like the polling because they like to benchmark with other of our clients or potential clients, you know, what people do and what thinking is around new standards. So that's really part of why we do the polling. I want to sense check my ideas, but also for you to sense check what other entities are doing. So at this stage, we've got 55% have voted. And I think this one comes as no surprise. 91% of you would prefer or think they would be using the cost model for this right of use asset. 8% the revaluation model, where we put the revalued amount in reserves or other comprehensive income, and 1% the fair value model. So very interesting. Thank you for participating. If we look at the last section, which is remeasurement of leases, very important to understand that remeasurement of leases does not address changes to the contract terms. That would be a modification of the lease, and we'll do a separate webinar on that, and quite complex. Remeasurement is just where we have a reassessment of the original lease term. So we have a reassessment of whether we will exercise an option to extend a lease term, or a reassessment of whether we'll exercise a termination option. It's also around a reassessment of whether a purchase option at the end of the lease term will be exercised. So definitely the 2 parts that I've got in yellow there are around reassessing what we originally thought around lease term, originally thought about purchase options. And how do we account for those? We revise the lease liability using the new assumptions, and we use the revised discount rate when we reassess. Because we are remeasuring, it's an opportunity to use a revised discount rate. And also, we adjust our right of use asset by the same amount. So there's going to be no impact on profit and loss. If you look at the brown blocks, where we look at if there's a change in an index or a rate that's affecting a payment, or there's a change in an estimate of the residual guarantee, again, we would revise the lease liability using the new assumptions. So the new rate or the new CPI index, that impact our payments, and we revise our assumptions around what these payments will be. But we use the same discount rate. So this is very important. The discount rate is not updated unless the change in the lease payments results from a change in a floating interest rate. So that's very important. And you'll adjust your right of use asset by the same amount. So you can see I've differentiated between the yellow blocks where we will use a revised or an updated discount rate, as opposed to the brown blocks where we use the original discount rate, unless our payments have changed as a result of a floating interest rate. An example. So in this example, Entity B entered into a 10-year property lease with an option to renew for another 5 years. Now, on initial recognition of the lease, Entity B was not reasonably certain that it would exercise this option, and so the lease term was estimated to be 10 years. Right? So the alternatives were 10 years or 15 years, and they said, we don't think we're going to exercise the option, we think it's 10 years. Now, at the end of year 6 of this entity, of this lease, Entity B acquires Entity A, and after that acquisition, Entity B is now thinking, you know what, it makes sense for us to stay in this location. We think we are going to exercise this option, and therefore, really we think the lease term is now going to be 15 years. Remember, we're at the end of year 6, so if we now change the lease term to 15 years, the remaining lease term would be another 9 years, where if we didn't exercise this option, the remaining lease term would be another 4 years. So, so there's now, you know, economic benefit for us to use this building. So at the end of year 6, we're now reasonably certain we're going to exercise it, and we've got a remaining 9 years left. So it's very important that at that stage, we will recalculate the net present value of your remaining lease payments. We'll calculate over the remaining 9 years, which would obviously be different than the net present value of a lease liability for the remaining 4 years. And our journal will merely be debit the right of use asset and credit the lease liability. So if I look at our example, so very important that the resulting journal obviously debit the right of use asset, credit the lease liability. Before we did the remeasurement, our remaining balance would have been for the payments over the next 4 years, and we now update that to be payments over the next 9 years. Important, because we are reassessing the lease term, we will be looking at our revised discount rate. All right. Right. Thank you very much for joining us for this webinar. Please join us again next month. I think we still have a few things to discuss on leases. We still have to talk about lease modifications, definitely a big thing. We still have to talk about transition to IFRS 16. So we will advertise IFRS 16 webinars going forward. But thank you very much for joining us today. We hope you have a good day, and we'll speak to you again next month.